There is a particular kind of silence that falls over a person the moment they realize their bank account has been frozen. It doesn't arrive with a phone call. It doesn't come with a letter slid under your door at midnight. It arrives the way most financial disasters do. Quietly, impersonally, and at the absolute worst possible moment. You're standing at a grocery store checkout, or you're trying to pay for a tank of gas on the way to work, or you're attempting to wire rent money to a landlord who has exactly zero patience for your explanation. And the card declines, and declines again. And the app on your phone, the one that's supposed to show you your balance in real time, simply won't load. That is the moment. That is when the architecture of your financial life, something you spent years quietly and carefully constructing, reveals just how fragile it always was. We talk a lot in this space about wealth, about building it, about protecting it, about the instruments and vehicles and strategies that the financially literate use to keep their money working while they sleep. But today, we're going to talk about something different. We're going to talk about what stops working the instant the bank decides to put a wall between you and your funds. Because in 2025 and into 2026, account freezes have become one of the most disruptive financial events an ordinary person can experience. And they are happening with increasing frequency, and for an expanding list of reasons. Banks lock accounts for suspicious activity, unusual transactions, legal orders from courts, unpaid debts, tax issues, outdated identification, and mismatched account information. Some of these triggers are perfectly reasonable. Some of them are bureaucratic overreactions. And some of them, particularly in an era of aggressive regulatory surveillance, are simply the result of being in the wrong category of customer at the wrong moment. Banks have been proactively closing and freezing accounts without notice, leaving customers stranded. And stranded is precisely the right word. Because when it happens, you discover something quickly. A number of the things you believed were valuable, things you may have spent real money acquiring, real time maintaining, are worth almost nothing without liquid access to the banking system. These are those 5 things. Number 1, your credit score. This is the one that tends to shock people the most because a credit score feels so permanent, so institutional. You spend years doing everything right. Paying your cards on time, keeping your utilization below 30%, disputing the erroneous collections from that gym you canceled in 2019. You've watched that 3-digit number climb like a slow-moving stock, and you are proud of it. And then the bank freezes your account. And what you discover, almost immediately, is that a credit score is not wealth. It is access to debt. It is a measurement of how reliably you have serviced obligations in the past. But servicing obligations requires liquidity. It requires the ability to pay. The moment your bank account is frozen, your automatic payments stop, your mortgage autopay stops, your car loan autopay stops, your credit card minimum, the one you set up 3 years ago and never think about, stops. You're not choosing to miss these payments. You are not irresponsible. You're locked out. But the credit reporting agencies do not have a checkbox for account frozen by institution. They have one for payment received and one for payment not received. 30 days after a missed payment, a derogatory mark appears, and the score you spent years building begins to erode in a matter of weeks. In a market where mortgage rates remain elevated and lenders scrutinize credit profiles with surgical precision, a credit score drop of 50 to 100 points can disqualify you from a refinance, jack up your car insurance premium, and make your next rental application a much harder conversation. The score itself doesn't vanish, but its purchasing power, its ability to open doors, deteriorates shockingly fast once the payments stop flowing. A high credit score without liquid bank access is like a beautiful letter of recommendation from someone no one can reach for verification. It meant something. Past tense. Number 2, your investment portfolio. Here is a belief that many people carry, and it is an understandable one. Even if something goes wrong with my checking account, at least my brokerage account is separate. At least my 401k is untouched. At least I have my investments. And technically, that is true. A bank freeze does not automatically extend to your brokerage. The Securities Investor Protection Corporation and the FDIC are different animals, and they operate under different legal frameworks. But here's the problem. Your investments, in most practical scenarios, are not cash. They are positions. They are shares of index funds and individual equities and bond ETFs. And converting those positions into spendable money, money you can use to pay rent, buy groceries, or keep the lights on, requires a chain of transactions that flows directly back through the banking system. You sell a position. The proceeds land in your brokerage's sweep account. You initiate a transfer to your bank. Your bank account is frozen. The transfer is rejected, delayed, or returned. You're holding a portfolio worth perhaps $60,000, and you cannot access a single dollar of it for your immediate needs. There is also something darker at play here. A frozen account can sometimes be accompanied by a broader legal hold, creditor judgments, IRS levies, court-ordered garnishments. And in those cases, agencies like the IRS can freeze accounts to collect unpaid taxes. And these types of freezes don't always require a court order. The reach of such a hold can, in certain circumstances, extend further than people expect. And then there's the behavioral trap. If you're frozen out and desperate, you may be tempted to take an early withdrawal from a retirement account. A 401k early withdrawal before age 59 and a half carries a 10% penalty plus ordinary income tax on the full amount. In a moment of crisis, a $20,000 withdrawal can cost you $5,000 to $7,000 in taxes and penalties. The investment existed, the value was real. But the friction of accessing it turned a paper asset into a costly, diminished, and irreversible transaction. A portfolio without access to the banking rails is a painting in a locked museum. You know it's worth something. You just can't take it home. Number 3, your emergency fund. Oh, the irony. The emergency fund, that sacred pool of money that every personal finance expert, every financial advisor, every well-meaning article on the internet has instructed you to build and maintain. 3 months of expenses, 6 months, maybe more. You did the right thing, you set money aside, you kept it in a high-yield savings account or perhaps a money market fund because you were responsible, you were prepared. But here is what the build an emergency fund advice almost never addresses. What happens when the emergency is the bank? Keeping all your money in one bank or app can be risky. Spreading savings across multiple financial institutions reduces the impact if one encounters financial difficulties. This is the lesson that thousands of customers of fintech apps learned the hard way in 2024 and into 2025, when a dispute between a third-party payment processor and the underlying bank left them completely locked out of funds they had every reason to believe were safe and accessible. The emergency fund, sitting in a frozen account, is not an emergency fund. It is a number on a screen that you cannot touch. The purpose of an emergency fund is immediacy. It is supposed to bridge the gap between crisis and resolution. It is the buffer that keeps a car repair from becoming a missed rent payment, and a missed rent payment from becoming an eviction proceeding. If that buffer is behind a locked door, it provides zero protection in the moment it is most needed. The psychological damage alone is significant. People who believe themselves prepared discover they are as exposed as if they had saved nothing at all. And that realization, that the safety net had a hole in it, tends to produce decisions that compound the original problem. This is why financial historians who study liquidity crises keep returning to the same lesson. Access is not the same as ownership. Having money and being able to use money are two entirely different conditions. Your emergency fund only functions as an emergency fund if it is liquid, accessible, and ideally not subject to a single point of failure. Number 4, your business. Revenue and receivables. This one is for the entrepreneurs, the freelancers, the small business owners, the independent contractors who invoice clients and receive payment into a business checking account. When a business account is frozen, everything downstream from it stops moving. You have outstanding invoices. Clients owe you money, maybe good money, maybe several months' worth of income sitting in accounts receivable, waiting to be collected. But those payments, when they arrive, will land in a frozen account. You cannot pay vendors, you cannot pay employees, you cannot process payroll, you cannot fulfill orders because you cannot pay your suppliers. The receivables become unreachable, the revenue becomes theoretical. And here is the part that makes this uniquely devastating. Unlike an individual consumer, a business has counterparties. It has vendors who will pull their terms. It has employees who will leave. It has clients who will interpret non-delivery as breach of contract. A business account freeze does not just inconvenience the owner. It ripples outward through every relationship the business has built. Courts can require a bank to lock funds because of debts, tax issues, or child support judgments, and this can happen without advance notice. For a business owner, a freeze triggered by a disputed tax liability or an unresolved judgment can shut down operations entirely within 72 hours. Suppliers stop extending credit. The SBA loan that was supposed to fund expansion sits inaccessible. The line of credit attached to the same bank is simultaneously frozen. Businesses run on cash flow, not profit. A business can be profitable on paper and dead in reality if the cash is locked up. This is a lesson that Silicon Valley's banking crisis in 2023 illustrated dramatically, when businesses that had done nothing wrong found themselves unable to make payroll because their bank had collapsed and their funds were temporarily inaccessible. Revenue is not real until it can be deployed, and in a freeze scenario, even collected revenue becomes phantom income. Number 5, your digital payment ecosystem. This is the most modern entry on the list, and in many ways, the most revealing one about how profoundly the financial world has changed in the last decade. Think about the invisible architecture of your daily financial life. Your Uber account is connected to your bank, your Apple Pay, your Google Pay, your PayPal, your Venmo. The subscription services that keep your business running, your software licenses, your cloud storage, your payment processor, your email marketing platform, your landlord's online portal, your insurance premium, your streaming services, your children's school lunch account. Every single one of these services pulls from your bank account, directly or indirectly. And when the account is frozen, this entire ecosystem begins to collapse, one failed transaction at a time. PayPal, for instance, will attempt a transfer and receive a rejection. It may then limit or close your PayPal account, because a rejected bank transfer can trigger their fraud detection algorithms. Your Venmo requests go unprocessed, your digital wallet stops functioning, the contactless payment experience that has made modern life seamless becomes inoperable. And this is the particular cruelty of the digital economy. It has optimized away the redundancies that used to exist. There was a time when you might carry cash, keep a checkbook, maintain relationships with multiple financial institutions, and have physical payment methods that did not depend on a single bank account being active. That time has passed for most people. The convenience that comes from linking everything has created a fragility that is invisible until it fails. It is essential to understand where and how your money is held. By being cautious, staying within FDIC insurance limits, and monitoring accounts closely, you can better protect yourself from potential losses. The irony is almost too sharp. The more financially sophisticated you became, the more you embraced mobile payments, digital wallets, automatic billing, and linked accounts, the more exposed you are when the foundational account goes dark. Technological sophistication, without redundancy, is just a more elegant form of single point of failure. The lesson history keeps teaching. Every financial crisis throughout history has returned to the same fundamental truth. Liquidity is not a luxury. It is the operating system on which all other financial activity runs. The Great Depression did not merely destroy wealth, it destroyed access to wealth. Banks that held real money, real deposits, real assets, closed their doors, and suddenly the gap between what people owned and what they could use became an abyss. The same dynamic, scaled differently, played out in Argentina's Banco Corralido in 2001, in Cyprus in 2013, in the Silicon Valley bank collapse of 2023. Some measures of banking system vulnerability have been higher in recent years than the low levels attained between 2015 and 2020, and remain elevated compared to historical standards. The system is more resilient than it was during the 2008 crisis, but resilience is not immunity. The question is not whether a freeze could happen to you. The question is whether you have built a financial life that can withstand one. Diversified banking relationships, physical cash maintained for short-term emergencies, multiple payment methods that do not all trace back to a single institution, a working knowledge of what triggers account freezes and how to respond quickly and calmly when one occurs. Because the 5 things we discussed today, your credit score, your investment portfolio, your emergency fund, your business revenue, and your digital payment ecosystem, do not lose their existence when your account is frozen. They lose their function. And in practical terms, that amounts to the same thing. Value in finance has always been contingent. Contingent on access. Contingent on liquidity. Contingent on the quiet, invisible cooperation of systems that most of us never think about until they stop working. The bank freeze is not the crisis. It is the moment the illusion lifts. And what you see underneath it tells you everything about how prepared you actually were.